नीचे किधर आप इधर से किधर गया
नहीं मैंने मोबाइल लिया नहीं उसको बोला भी
प्रशांत को पूछो प्रशांत है ना मेरे साथ ये भी क्या है अभी इट इज नॉट टेकिंग द ऊपर नहीं आ रहा है हाँ? इसको एक कीजिए वीडियो सिस्टम सेटिंग इसी कैमरा कौन सा ठीक है उसमें आता है तो होप होने के Hello, testing. Vipra, can you hear me?
Good morning, sir. Yes, we can hear you, sir.
Good morning. Thank you.
So this is Ali Hadar from NIDM, sir.
Mr. Hidan. How are you?
I'm fine, sir. How are you, sir?
Good, good, good. My throat is a bit bad.
Yes, sir.
I think Mr. Santosh Kumar is coming late, right?
Yes, sir. He will be joining soon, but he's in a meeting right now.
Okay.
But he will be joining.
Good morning, sir.
Good morning, Shipra. How are you?
Good morning, sir.
Good, sir. Good, sir. How are you?
Let me know. I mean, is Mr. Manoj, then is Major Manoj Kumar will coming today? Major General?
Sir, he'll be joining after 11:30.
Okay, and Santosh Kumar also.
Yes, sir.
So probably I have to start the program.
Yes, sir. Sir, we can, are we calling MC Chaturvedi, sir, to this
I
meeting?
think today Mr. Deepak Godbole should be speaking. Let me just find out.
Okay, sir. Okay.
Shipram, Mr. Deepak Godbole would be speaking in the beginning.
Okay, sir.
Then I will be taking care. Then I will be taking it forward. You
Okay,
can
sir.
do the announcements accordingly. He is Secretary General,
Yes.
Insurance Institute of India.
Yes, sir.
He will give the introductory address
Right, sir.
and set the tone of the meeting, and then from there I would take that.
Sure, sir.
And when Mr. Santosh Kumar comes, alert me. Accordingly, I'll wind up,
Yes, sir.
and then he can take over. I'm not made presenter, right?
Sir, I will make you the presenter after
Okay, at that time,
the
right?
Yeah.
Okay. Okay, now share has come. Right?
Yes, sir.
फोन वगैरह आएगा तो बाहर जाके बात करूं. We'll start after some 5 minutes or something, or Shipra?
Yes, sir. Whenever you say so, we can start again.
No, I think only 49 people are coming. No, more people have to come. No.
Yes, sir. People are
Let us-
joining.
Yeah, let us wait for 5 minutes. 11:05
Sure,
is
sir.
okay.
Sure. Very-
We have come to 65, 66. Okay, people, more and more people are joining. So let's wait another 1 minute.
Sure, sir.
Madam, you can start.
Yes, sir. Good morning and a very happy Constitution Day to all the esteemed panelists, respected dignitaries, participants. On behalf of NIDM, I extend you all a very warm welcome to this third webinar of this series on disaster risk financing and insurance, disaster and insurance awareness, monthly online webinar for Andhra Pradesh, Karnataka, Kerala, Pondicherry, Tamil Nadu, Telangana, jointly organized by NIDM and Insurance Institute of India, Mumbai. This is the third webinar of this series, and with this, now I take this immense auspicious opportunity to welcome and introduce the Shri Deepak Godbole, Secretary General, Insurance Institute of India, Mumbai, for their inaugural address. Welcome, sir.
Good morning, everybody. And yes, it's a very important day, the Constitution Day. So greetings to all of us. This is a very nice day to conduct this third webinar in this series, especially looking at the structure of India, the relationship between the center and the states that has come out through the Indian Constitution. So what a wonderful opportunity that all of us connect with each other. I welcome my colleagues from Insurance Institute of India, from NIDM, and all those who have joined us today. I can see a good interest in participating, because by now I can see more than 70 people in. I believe they are all from Andhra Pradesh, Karnataka, Kerala, Pondicherry, Tamil Nadu, and Telangana. This is the third of the series of webinars that both these institutions, Insurance Institute of India and NIDM, had planned under the Disaster Risk Financing and Insurance Initiative, which I am happy to tell you that NIDM is doing its great job in managing and helping in disaster reduction mitigation. And Insurance Institute of India has actually connected all the insurance companies and reinsurance companies in India with NIDM to enlighten once again what kind of activities that we can do, what kind of contribution can be done by the insurance industry into this field. Just to give you a quick recap of what are we going to talk? Why are we here today? Disaster incidences are on rise, be it Asia, Africa, or Americas, or any part of the world. We are watching, we are observing, we are seeing that disasters incidences are on rise. Now, a lot of research is going on that as to how many of them are really the natural disasters, how many are actually induced by human beings, and all that kept aside, the fact still remains that the disasters are on rise. They present a broad range of human, social, financial, economic, and environmental impacts. The financial management of these impacts is a key challenge for individuals, for businesses, as also for governments. And this is the background why we have come together here. Why are we spending time on understanding the role of insurance industry in helping the individuals, businesses, and governments to come back to the activity levels those were pre-disaster times. So insurance industry actually plays a role in mitigating risks in the economy by encouraging proper risk management and providing a source of financing to respond to the damages and losses incurred by households, businesses, and governments. Now, just not talking about the disasters, but insurance industry all over the world, not only in India, is instrumental in propagating the safety measures to be followed in construction. So we say that when people are working at a high level, let them have their hooks to control their body, let them be wearing the helmets. Insurance industry would be also propagating for risk management on the wearing of helmets. If people are driving the motorcycles, they would be happy to see that the seat belts are being properly used. And how they do this is they do a lot of encouragement for this by also offering some kind of discounts, which are called as good feature discount when people buy insurance, and the premium discounts come in that. Going ahead, insurance industry can make an important contribution to the management of disaster risk by providing a source of funding for post-disaster recovery and reconstruction, and thus reducing the financial burden again on the affected ones, the households, businesses, and governments who otherwise would need to absorb all these costs. And we know that individuals do not have enough money, nor do the businesses have, and nor do the governments have, because unless a proper risk management framework is in place, even bigger businesses, we have a history and records that they could never come back after the large disasters. The global reinsurance market, both for traditional and alternative, provides an additional source of capital to mitigate the financial impacts, diversifying the risk away from the domestic economy and enhancing the capacity of primary insurers to provide affordable insurance for the catastrophe risks. This is the second level of the concept, that it is not only insurance industry which is within the territory of a country. There is also a mechanism of reinsurance where the risks are further spread and the risks go beyond a country limit. But the reverse of this becomes very important and useful, that in case of a loss in one country, because of the provision of reinsurance, the funding also comes from other countries. So it is a bigger way of risk spread. So therefore, insurance companies and reinsurance companies are key players in managing for the finances post-disaster. And that is where I repeat again, is all this activity that was started between National Institute of Disaster Management and Insurance Institute of India to bring the like-minded people who are insurance companies and reinsurance companies in India, along with NIDM, and then to reach to all those who are working in this area in different states. And this is the third in this particular series. Insurers and reinsurers, thus, by making use of pooling mechanism, so they pool the resources, achieve diversification of risks across populations, regions, leading to reduction in the aggregate cost of protection, and provide the much needed financial protection for making longer term planning and resource allocation decisions. Now, this is where If insurance industry is not there, the planning and resource allocation decisions remain only with the government. And the governments also have limitation on the resources that they have, including the financial resources. So it is always better that there is a supplementary level that is available. People make use of it. Governments make use of this method of insurance and reinsurance and relieve to whatever extent that they can. The insurance industry enables those affected to more quickly recover after the event because they are a source of funds for reconstruction, reducing the disruption to economic activity and also the financial stress on households and businesses. So you have something to fall back on and you can again start your activity as usual as quickly as possible, not depending for the aid that would come, that may come, may not come, and that may come and that may take a longer time to come. Insurance industry helps governments in as much as impact on public finances to cover the losses due to unexpected natural disasters remain negligible. This is a key thing because governments do have their plans, do have their programs, but suddenly an unexpected expenditure if comes up, then one has to understand that they have to fund this particular activity by stopping some other developmental activity like building a bridge or a port or an airport or something like that. And this is what is the role and effectiveness of bringing an insurance and reinsurance industry into the whole idea of disaster risk financing. And therefore, I would again say towards the end that NIDM is a key institution doing its job. It is supported by Ministry of Home Affairs of Government of India. Insurance Institute of India is a venture which is supported by the state-owned insurance companies in India, but the support in other different ways of knowledge sharing and such other things also comes from the private sector insurance and reinsurance companies in India. So we are through Insurance Institute of India trying to connect the insurance industry in this particular good venture. We keep trying to increase the awareness and showcase the utility of insurance mechanism for disaster risk management. And I think this should be a good starting for what is going to come later. We have expert speakers to discuss with you in details as what I have said, the role of insurance and reinsurance. And I think my request to the participants should be, please absorb as much as you can through this webinar. Please also take this opportunity to have an interaction with the experts who would be delivering their kind of inputs to you. And lastly, I would say this should not be seen as an end. This should be seen as a beginning of the relationship. Please get as much as you can get today and remain connected with NIDM and Insurance Institute of India. We'll be very happy to support all your efforts in all your states. Thank you so much. And I would give this thing back to Shipra madam. Thank you for this opportunity. I think I would wish a very good time to all the participants. Thank you.
Thank you so much, sir. Thank you for this deliberation. And now I would like to welcome Dr. George Thomas, Professor, Insurance Institute of India. Dr. George Thomas is a PhD in Management from University of Pune. His qualifications include MBA, MA English, MA Sociology, LLB, FIII, ACII UK, and Diploma in Insurance Law. He is a fellow life member of Indian Council of Arbitration and life member of Institute of Public Administration. He has conducted research studies in diverse areas of insurance, including microinsurance, as also insurance by mutuals, cooperatives, and community-based organizations. He has served on the advisory board of Cambridge Institute for Sustainability Leadership on Sustainable Development and COP26 as member of the Insurance Development Forum and as the International Insurance Society's ambassador for India. Welcome, sir. And I would also mention that he is part of a capacity building project for the insurance industry of Bangladesh led by PwC. So we welcome you to this session, sir. Thank you.
Thank you very much, Shipra. It was very kind of you to give me this much of a detailed introduction. And thank you very much, Deepak sir, for setting the tone for the day. We are really thankful to the NIDM for bringing in together this many leaders from the country, from across the country, and especially the focus being today on the southern states of India, which of these states have been for a long time not being affected by disasters, but in the recent past we have seen quite a bit of disasters from that that belt, that part of the country. So, thanks a lot for creating this forum for discussion, for open discussions, and also for planning and leadership in this area of disaster risk financing. So thank you very much for this opportunity and for all the initiatives from your side. We'll be listening to Dr. Santosh Kumar and Major General Manoj Kumar Bindal later on during the day. So let me just start this off, by starting my presentation. Is it visible, madam?
Yes, sir. Yes, sir.
Okay. So, friends, this is the discussion. This series of webinars comes under the disaster risk financing and insurance endeavor of the NIDM and III, and the focus is on disaster and insurance awareness. The monthly online webinar, third one in the series. First one was a general one. It was a general webinar across the states, across multiple states. The second webinar was focused on the northeastern states, and this is the third one focusing on the southern states. So today's discussions will be proceeding this way. First, we talk about the risk management through the insurance sector and how the insurance sector is globally and locally regulated for the policyholder protection, an overview of the insurance products, and insurance and disaster risk financing. So this is the general layout. These are not watertight compartments, so we will be discussing generally in this order, covering all these topics. And anytime, if you've got any questions, anything where I can discuss more in detail, I'm always happy to do that. Thank you. So let us look at the basics of risk, the risks that we are facing in everyday life. So we face the loss of livelihood, loss of employment. We face the risk of death, disease, disability, and nowadays we are facing the risk of not only dying early but also of living long, because pension is another area of challenge. When you lose your employment and when you don't have an income after a particular year, you need to be looking at post-retirement benefits also. So we are faced with risks like fire, explosion, breakdown, riot, strike, business liability, theft, robbery. When we are sending goods by transit, there are risks associated with transit, associated with travel, with vehicles by themselves. They get into accidents, ships, aircrafts, and to add to everything, there is the element of natural catastrophe, flood, earthquake, storm, cyclone. And also there are man-made catastrophes. The list is endless, friends. And we also see many kinds of liability risks nowadays. So these are things which are there to be faced. These are now all realities, and the insurance industry is providing solutions to all these, to some extent at least. We will discuss that as we move on. So this is just taking stocks of the risk that we are facing in everyday life. And let us look at the system of risk transfer to insurance. These risks, whatever we discuss, are our own risks. At a personal level, your car getting into an accident, the liability to a person whom you are hitting by your car, the costs which you have to pay for your treatment, the financial difficulty to your family if one of us die. So all these, somebody loses employment, all these kind of things are real risks, and these are all our personal risks which we talk about being transferred to insurance. Because even when you look at a car which you are driving, if it is stolen or if it gets burned on the highway, you easily spend 7 lakh to 10 lakh rupee cost, which is something hard for us to do. But when we pay a 10,000 rupees as insurance premium, the insurance company takes care of the value of the car and replaces the car. So, I mean, just very broadly speaking, same is the case for health insurance or life insurance, whatever. We pay a small premium and the insurance is taken over, the risk is taken over by the insurance company. Now, for this, the insurance company needs to assess the risk. What is the risk involved? It has to measure the risk, assess the risk, adjust about risk improvement, risk management, and the risk gets transferred from your pocket. Your pocket doesn't have to bear the cost of the loss, but it is getting transferred to the insurance company. So what is insurance company doing? It is selling you a promise that I will pay you this amount if these things happen in these circumstances, if these things not happen. Simple, right? This is a typical insurance policy which you have seen. So the concern over here is people understanding what is being promised and insurance companies being clear on what is being promised. These gaps are what create problems between insurance companies and people. So there is one area where there is confusion and lack of clarity in that how much is promised and how much of risk is been transferred. If it is not there, it enters into problems. But then there is one area where we need clarity. And in almost all the insurance policies, such clarity is already there. Then comes the area of underwriting and premium. What do you mean by underwriting? It is the gatekeeper of the insurance company. It decides how much of risk would be taken and what would be the premium which will be charged. And this has to be risk commensurate. What do you mean by risk commensurate? Risk commensurate premium, risk commensurate claims. Imagine one boat is capsizing. They take the Vembanad Lake in Kerala. A boat capsizes with 50 people. Say all of them, God forbid, all of them lose their life. Government will pay an amount of say 5 lakh rupees to everybody who lost, the families of everybody who lost their lives. Right? That is how it works. The thing is that somebody who is a headload worker, somebody who is a porter, somebody who is a software engineer, somebody who is a doctor, a nurse, the owner of one big company, all of them are traveling in the same boat which capsized. Every one of them gets the same amount from the government. This is the concept of solidarity. This is what the government can do. Government cannot discriminate between the persons who lost their lives based on how much of money they are earning in their life. There, the amount of 5 lakh rupees compensation may be a great thing for a porter, but it would be nothing for a software engineer or a doctor, or still again for the owner of a business. So this comes in risk commensurate premium. So based on your paying capacity, based on our own best estimate of our loss, we come across with a sum insured. This much is my sum insured, and this much is the premium. So these things are possible in insurance, but they are not possible by the government. Because most of you are from the government. Government functions on a solidarity basis, whether with premium or without premium. But the amount is not risk commensurate. The amount paid is not risk commensurate. For example, if a tsunami comes or if a big flood comes and 100 houses get damaged, government pays the same amount for everybody. The government cannot afford to pay the differential compensations to checking how good your house was. So, okay, so there are areas of insurance contract which look into all this, things. The insurance companies have got the challenge of marketing and sales because they need to look at high volumes, because whatever money they get in, it has to be from a large public. It has to be spread over a lot of people. So insurance companies should have a lot of people who would be sharing the same kind of risk and whose small premiums are sufficient to take care of the one loss or a few losses. The number of people who are insured has to be very much higher, and the actual number of people who suffer the loss. And only this, because insurance company doesn't bring in money to pay sufficiently for all the losses. While it is operating, it will have that money, it will manage that money, but there is only 10 people and all 5, and out of which 5 people have losses, in no insurance company would be able to pay that. But all the 10 are potential loss makers. All these calculations, all these things go into actuarial calculations, marketing, sales. So all these angles are there. Then there are difficulties in claims assessment, processes involved, people who defraud insurance companies. All that is there, So people don't feel that this insurance company, the money with the insurance company is so sacred and all that. Look at it. What is the money that the insurance companies have with them? They're the money of the widows of all those people who lost their life in the boat. All the life insurance people, all the people who are insured for life across the country, their widows, if these people die, it is their money. It is the money of the person who has paid a little bit of money as premium and who is going to be suffering of a heart attack or a stroke or a kidney problem. It's big money. It is the money, the money which the insurers have is the money of the widow, of the orphans, of the sick people, and of the people who lose their houses in some kind of flood or cyclone or tsunami. Right? So this is this money which we are talking about, but then people don't understand this and they do commit insurance fraud. Anyway, that is another area to talk about. So what we saw, friends, over here is that insurers need to reach out. To be viable, to stay in market, to be in business, insurance companies need to reach out. And how do they reach out? They reach out through agents, reach out to brokers, through direct sales, company sells it directly. There are different models, micro agents, CSC, VLD, rural authorized persons, village level entrepreneur, partner agents. They tie up with NGOs, self-help groups, mutuals, cooperatives, group businesses are done. Employers and other groups are there. So there is the bank assurance, insurers tie up with banks to make their products available. Then there is after-sales service requirement, claims assessment. So insurance companies need to deal with loads and loads of people. They need to connect with the large number of people to be able to sustain the losses that would anyway come. So then comes the challenges faced by insurers. First of all, when they have got a large pool of people to share the risk and the money has to be kept in proper shape, money has to be kept properly invested so that there is sufficient money to pay the claims. Insurance companies need to have officers, they need to have people. There is management expenses, establishment expenses, they should have computers, they should have money to print the policy, the promise onto a piece of paper and give you and post it to you. Okay. So insurance companies are a part of the insurance premiums collected, go to all that. They need to build credibility in the minds of the people, because they are dealing with promises, and promises means trust, and for trust they should have credibility. So insurance companies work hard to keep their credibility intact. They need to grow also, because yesterday's numbers are not sufficient for tomorrow. We are getting more and more risk. I'll talk again on risk, I'll come back to that. But then they need to invest the money properly, because it should be beating inflation. It is public money. Need to look at accumulation of risk also. A lot of an insurance company has covered a lot of risks in Chennai, inside the city itself. If something happens within the city, one insurance company will have to bear the entire cost, which will be too high. So if there is accumulation of risk, insurance companies plan the accumulation in such a way that there's a geographical spread, there's a spread across different industries, and also whenever it is something that they can't handle themselves in terms of money, they pass it on to the reinsurers. So what happens? See, about the NatCat risk disasters, natural disasters that we're talking about, generally affect a huge number of people, a huge area of people. Then what? Unless it's reinsured and transferred over a larger number of players, larger geographical terrain, it cannot be sustainable. So insurers get into reinsurance. Then again, coming to back to sustainability, we have seen a lot of players, a lot of products in the Indian market in the last 7 years, especially. The Indian government has been all along supportive of the insurance system. They want everybody in the country to be benefited, especially the poor and the downtrodden. They want them to be benefited by insurance. So even the current government has done wonderful job in connecting their country through simple products like the PM, the Ajivan Bima Yojana, the Swasthya Bima Yojana, the Fasal Bima Yojana, then the PM Ayushman Bharat scheme. So, there are different ways by which the government is connecting and trying to provide insurance support at subsidized rates to the entire country. This is something which many countries across the world, they're not able to achieve. So I'm part of a body called Insurance Development Forum, which is a worldwide forum. There we try to make governments and governmental bodies aware of these things and try to make them act. In India, we are far ahead. The development agenda of insurance, the idea of giving the poor people the benefit of insurance is deep rooted in the Indian government's philosophy. The Indian government has been working on this across the years. Then, what are the challenges when all the money of all these people are going to a few hands and they have already done their part of a contract? That is, people are paying their premiums and the insurance company to deliver. There are certain ways by which the government regulates the insurance companies. So I'm telling this to you because people mostly don't understand how insurance works and how tightly insurance is regulated and how tightly insurance is managed. There is an IRDA, the Insurance Regulatory and Development Authority of India. There is an act for that passed in 1999. The IRDA was formed in 2000, and it has got a lot of strong regulations whereby every single entity getting into the insurance world, from a giant company, from a giant insurance company to the agent, to the village level entrepreneur, to the rural authorized person, to the broker, to the TPA, to the surveyor, every single person is regulated. There are entry level criteria of licensing, of knowledge. There is codes of strictly practiced codes of conduct. These things get better and better by the year. I mean, some of us have lost money in 2007 because of mismanagement or sales or mis-selling in the area of ULIPs. The regulator and SEBI, the insurance regulator and SEBI have learned from it, and they have put stricter control so that people don't sell insurance products loosely. So there are norms for that. So, and also there are social and rural priorities also which the government follows, makes the insurance companies follow. Otherwise, insurance will focus only on the cities, major cities. So the government enforces that the insurance companies go into the rural parts of the country and go to the people who are not part of the social and the geographical social and the the geographical areas. And it is also insurance is aligned with the environment. It is aligned with the Marine Insurance, with the Marine Insurance Act, motor laws. So it is aligned with other laws of the country. So insurance companies work hand in hand with all the other legal and regulatory things of the country. So there is nothing that they would be doing separately. It is they're all part of the government's total plan for the country. And then there is the international level. The international community watches, observes what every country is doing. And India is no exception. There's a body called IAIS, International Association of Insurance Supervisors. They do set standards by which regulators have to regulate the insurance industry. Like the IMF or the World Bank set standards for the for the RBI regulate the banking industry. Like you all heard about the Basel standards and things like that. So there are international standards, 26 of them, which the IAIS, International Association of Insurance Supervisors, they do connect with every single supervisor, every single regulator, insurance regulator across the world. So the same kind of standards which are applied in Canada or in USA or Germany or France or Ethiopia or Nigeria are applicable to India as well. So there are regulations, and there are also regulations. So there are these standards are set, and the regulator also regulates in tune with what is being done internationally. Because you look at it, regulation, insurance is an international business. As Godbola sir was telling you earlier, when the Thailand floods happened, or when floods happen in some other part of the world, when any calamity happens in some other part of the world, all the insurance companies connected with them are to multiple companies across the globe are all linked together. When a flood happens in Thailand, the General Insurance Corporation of India also pays, and vice versa. Because that is how, when there are natural calamities, that is the only way how the entire world can manage. There are situations where an entire government gets wiped off. There are small island nations, there are reports. Small island nations get wiped off. So these are things which can happen. Accordingly, insurance industry is geared up. Insurance industry is regulated. So you don't have to be worried when you are dealing with an insurance company because they are fully regulated. Even for micro insurance, there are regulated. Actually, India was one of the first countries to bring out regulations on micro insurance. This insurance for the poor people, insurance for the small sector. So you can be absolutely comfortable that it is a fully regulated business. And if there is any problem, there are insurance ombudsmen, there's the IRDA, there are consumer codes, there are various mechanisms whereby you can approach for grievance redressal. They can. And every insurance policy has got the name and address of the insurance ombudsman. It is something like telling your girlfriend, "This is my mommy's mobile number. If I don't behave with you properly, you can call up my mommy." No, it is something like as simple as that. So every single policy sold in the country has got the insurance ombudsman's telephone number and address on it. So you can complain against us if we misspeak, right? So the customer confidence should be there in that. Further, there are solvency. How do we ensure that the insurance company doesn't get closed down? It's a big headache. It happens all over. In India, before the LIC was formed in 1955, in 2 years, 50 insurance companies were closed down. Out of which 25 were gobbled up by 4 or 5 big insurance companies. Yes, fine. But the remaining 25 were just closed down. Imagine that situation. Insurance company, you have been paying premiums for a 30-year insurance policy. After for 10 years, the company is no longer there. You have paid your motor insurance premium or health insurance premium for a few months, and when you come there with a claim, the company is no longer there. These are scenarios which has happened elsewhere in the world. But we are very sure that that kind of situation will not happen in India, will not happen today in most of the well-regulated areas. And India is one of the most beautifully regulated countries when it comes to insurance. Government takes a lot of responsibility. The regulator takes a lot of responsibility. The solvency of the insurance companies are checked as frequently as possible. They have to disclose their quarterly results. They have to publish their half-yearly results. The IRDA audits each insurance company, broker, every insurance mechanism, online and offline. The stress testing that is in such a scenario happening. If a tsunami comes, will the insurance company have the money to pay? All this testing is done. The scenario testings are done. Every single product which is sold in the insurance industry has been vetted by the insurance regulator. Why do I say that? All of us in this discussion, in this webinar, have got insurance policies. But how many of us have really read it? You have a motor policy, you have a car policy, you have the policy for a scooter, for a house, for a health, for a life. Have you really read it? And what is this group which I'm speaking to? This is one of the top level of the country. People in well-educated, people who know things, people who are competent, knowledge-wise, position-wise, lifestyle-wise, power-wise. This kind of a group doesn't read insurance products. Then who will read? Will the school teachers read? Will the college professors read? Will the bankers read? Will the people who have these shops read? Will the auto drivers read it? Will the salesmen and salesgirls in the shops read it? No one. And what is the price which is being charged? The regulator goes through it. There are norms for that. There are product regulation guidelines. So the regulator goes through every single product which is sold in the Indian market and vets it. It checks it for the wordings, for the pricing. The insurance companies are managed, well governed. There are governance norms. There are corporate governance norms. There are controls on reinsurance. There are global best practices are followed. For investment, for accounting, for audit controls, there are well-regulated norms which are applicable in the market. Why is accounting so important? Simple, because clever accountant can hide a lot of wrong figures in a big figure. Friends, it is not lion that eats the whole elephant. It is the mice and the ants and the small vermin which eats up the elephant. The lion takes only a few bites. Losses happen by micro losses. Big losses happen through micro losses. So the insurance companies don't allow that. The insurance regulator doesn't allow that. It has put cleverly worded accounting norms, accounting forms, investment norms, audit controls to see that no insurance company can pay with public money, the policyholders' money. There are also norms regarding claims. If you see any insurance company's website, there is a citizen charter over there, as decided by the regulator. It is the statement by an insurance company to its customers, how well they are paying their claims. What are the turnaround times? TAT's turnaround time. What is the turnaround time for a claim? The systems of ombudsman I already told. Insurance companies have got their own internal grievance portal. And if they don't reply to your claim within a month, the copy gets escalated automatically to the regulator. It is very, very tightly monitored, tightly controlled industry, because there is scope for doing wrong things. The government in India, the governments abroad, and every possible country has got very good controls on the insurance company to ensure that nothing goes wrong. Let us move to the kind of products which are available in the insurance market. We get life insurance, personal accident, health insurance, travel insurance, and pensions. These are at the personal level. At the physical level, let us look at it. We have got houses. Houses are covered. right? The property which you have, the machinery, your factories, implements, agricultural implements, your projects which are coming up, that is your houses, your buildings, your dams, all these things are covered. Towards the flyovers, everything else is covered. The cargo that you send, transport, which you see in big trucks moving across the city, they are all insured, mandatorily insured, because otherwise they won't be able to. The vehicles are mandatorily insured because a vehicle can go and hit anybody. Crop insurance, we have talked about that. Then there is cattle insurance, there are motor vehicles insurance, I told you, there are ships are insured, aircraft are insured. Some places is insurance, some rare areas insurance is mandatory, but in other cases it is prudent for insurance companies to have insurance, because without that it will be very difficult for them, it will be very costly for them to survive. So businesses are insured. Business interruption, have you thought of that? If you have a factory and then it is gutted by a fire or by an earthquake or by a flood, an entrepreneur, you will be losing profits. You have got commitments to make, commitments towards other parties to give, to deliver finished goods. You have got commitments to the people who have supplied you material. All these are taken care of. You need to pay the rent, even if you're, people have seen it, during the tsunami time. During the tsunami time, I'm sorry, during the pandemic time, the COVID-19 situation, we have kept our shops and factories closed. Still, we are paying rent. We have to pay some amount of electricity bill also, salaries also. So all these kind of things can be covered in a proper manner under a loss of profits or a business interruption insurance. There are credit risks, deaths of key employees. There will be a key employee who is running your company. He dying, nobody would know where the systems are, where something happens. Employees are covered. Event cancellations, we all know about the Olympics or a cricket or a tennis or a Wimbledon cancellation, what can happen. Even a small event, a wedding in a small town, if that wedding has to be cancelled, how much of money is lost? Insurance is there for that. Because of heavy rain, because of flood, because of cyclone, you are not able to conduct a wedding in time. It can be passed on to an insurance company on a premium. Even I'm coming to that level of a wedding or a social function to that extent. So I'm not even talking of big IPL events or football events, anything like that. So even at this personal level, we are able to use the insurance mechanism to hedge our losses. For liabilities, there are various liabilities. You may be dealing with some hazardous chemical. It need not be a union carbide to create environmental pollution. Even small people. It is small factories can pollute people. Even somebody comes to your office and there is a water spillage or soap spillage over there, he slips and falls. He can sue you. There can be mistakes. There can be omissions. The products that you are selling, they can be damaged by rain, or they can be damaged. They can be contaminated. So for that, there can be a liability. I'm not speaking, friends, here on behalf of any insurance company. I'm not an insurance agent. I'm an insurance teacher. I was with the insurance regulator 25 years of my service, and for the remaining 11 years, I'm part of insurance academics. My PhD is in insurance regulation, so I don't have any axe to grind over here to say that you go and buy insurance. We are talking over here at the NIDM forum because there's a governmental mandate to spread information, to spread awareness about disaster and insurance. We are trying to extend the governmental agenda that people of this country are well protected from disasters, whether it is man-made or whether it is natural. So, there are, cyber liability, you have been seeing it quite during the tsunami time, about you get fraud calls and things like that. If you're properly insured, these things may not affect you the way it would affect others. So many of these losses that we have talked about in this under these four heads could be arising out of natural catastrophe. So death due to natural catastrophe, illness due to natural catastrophe, accidents, travels getting affected by natural catastrophe. Many of these things can be because of natural catastrophe also. So these things we should be aware of. Now, looking more specific at the disasters and about the natural catastrophe and climate change and stuff like that, you need, as we talked earlier, we need a large geographical spread. The losses have to be directly or indirectly covered under many policies. You need not have one policy which will cover everything, all your problems and worries because of a natural calamity. You need not have to cover in one single policy. You can. Some of them will be covered in your car policy, some under your house policy, some under your life policy, so it can be all covered into different policies. But for the insurance companies to manage this thing, okay, that's a challenge. So for you as a customer, when a customer looks at it, there are personal risks and organization risks, as we said. But when an insurance company has to manage this entire thing, it needs to manage things based on dependable data. If insurance companies have to be effectively managing disasters, it can come only with your support, because people in government, people in responsible positions in power, insurance companies don't have power, you have it. With your power, you can gather dependable data. You can gather data and give it to insurance companies on how the floods have been affecting the crop in our country, how in your particular district or in your state, how floods have been affecting cattle, how they have been affecting crop, how many deaths have happened because of a cyclone. These things, look at it. If you look at generally published statistics, the number of deaths caused by disasters are reducing. They're coming down because of the early warning systems in the country is getting more and more developed. You don't have to be worrying much about deaths in recent years as much. If you're looking at statistics of 50 years back, such a lot of people were dying because of a weather event, because of a cyclone. But today the number of people who are dying is less, but comparatively, and the people who are and the amounts at stake, the losses which happen to property, belongings, money is much more now because the country has become wealthier. It's a fact. Over the period of time, if you're looking into the 50s and 60s compared to that, we are a wealthier country. Each one of us, each family is wealthier. There is lots of money which is lost when a natural disaster happens. And the insurance companies need to focus on more reinsurance and about insurance pools. It should have the right disaster coverages and the right sum insured. The coverage, these things need a better awareness of in the country of how to managing things. So under the governmental mechanisms across every state is well aware of insurance, they will not be able to take the best benefit out of insurance. Nobody expects that an insurance company person will come and teach you insurance. Friends, most of our knowledge about insurance has come from one uncle. Every one of you will have of an uncle when you talk about insurance, not your uncle, some uncle in the neighborhood who would approach your dad when you passed your SSC or when you passed your in your graduation and said that, okay, we will invest something in life insurance for this boy. It would have been an olden time life LIC agent. He would have been the person who introduced the concept of life insurance to the families, to most of us. But then, is that what we need to know? There is much more. Insurance is a very, very significant, very big area of knowledge where the entire country needs to know about how insurance works, so that you get maximum benefit, so that nobody gives you half information from an insurance company, or you should not have any apprehensions about cheating or be cheated. That kind of situations have to be avoided. That is why we are the NIDM and AAA are focusing on creating insurance awareness. Each one of you should know what insurance you should take and how much you should take, and what insurance you should not take. What insurance you need not take. So that is something you don't have to waste money on the insurance which is not required for you. So a proper assessment of your own risk is something which is we are trying to make you capable of doing that. And of course, it is not over with this series of webinar. Here we are creating awareness. We are also planning to have state level or cluster of state level training programs so that you are well aware of what kind of risks you are exposed to. NIDM is taking the initiative along with AAA so that people in the state governments are aware of what kind of insurances are required, how much to insure, and what types of insurances, and don't and especially not to let you waste your money on unnecessary insurance. Okay, so let us move to the next area. This is sort of a snapshot and a kind of the overview of what we were discussing. Shipra madam, how much of time do I have now?
You can
You have
continue
good time.
for,
You can continue.
Okay, Dr. Santosh Kumar, you are back, right? Okay. So I just thought I would recheck on the timing part. I don't want to deprive the Mr. Because Mr. Santosh Kumar will be speaking on a very, very important area about disaster relief plans from the PM's agenda for disaster relief and the country's focus. We have worked together on various aspects on this, and he has got lots to tell you. So let me, having been satisfied that I got the time, so let me just tell you we were talking in the first area that there are multiple risks which are being covered. And natural losses caused by natural catastrophes are also covered traditionally. But there are some areas which cannot be measured, like the sovereign risk, but the losses which can happen to the government. After a tsunami happens, after a weather condition happens, after flooding happens, how much of money does a government need for reinstating its own governmental property? Dams, bridges, government buildings, and all that. What mechanisms do we have to finance that losses? These are difficult to quantify. But who will quantify it other than you? You won't like to leave it to the insurers to quantify it. Insurance can accept that, but it has to be scientifically measured, scientifically quantified and defined. So for that, you need a lot of knowledge. That's what we are trying to point out. And you have got a lot of people who are beyond the mainstream, people who are working in the farms, the agricultural laborers, people who are working in the unorganized sector, a lot of migrant workers in your own state, and a lot of migrant workers from your state who have gone to some other state. Who takes care of them? Some of them, despite the country doing this much of work, hard work on this, there are people who still don't have a proper ration card. There are people who are not eligible to get many of the governmental support. Supports are there, they don't know that they are eligible for that. It happens. It happens in a small way. It happens in some part of the country. We're not trying to attribute blame because ours is a large country, highly populated country, and it is difficult for any governmental mechanism to have a magic wand and to just cover everybody in the country into that. And there are people who are tribals, fishermen. Their own needs are different. So traditionally, some things are not insured, which are beyond insurance and reinsurance, beyond contract failures. There are wars cannot be insured because the kind of losses can be multi-catastrophic. Traditionally, ionizing radiations or nuclear weapons, these are not insured. I mean, the damage caused by them cannot be insured. Once upon a time, we were thinking that environmental pollution and climate change cannot be insured. But then the country is moving towards this situation. World is moving towards the situation of covering multi-catastrophic risks, including environmental pollution and other aspects which happen, other problems which happen to the environment. The government is trying to do, I mean, the governments across the world are trying to do that. Recently, friends, you have seen in the first week of November, there was the IPCC meeting where they were discussing about carbon emissions and when are we going to move to that. So we all the countries have set their own targets about when they are going to move. There are new types of risks which are coming. Are you aware of that? What are the new types of risks which insurers are yet to think of, but it's going to hit us hard? There is a lake Baikal in Siberia, which is one of the oldest lakes in the world. It has got 2,500 species of life. Since 1970 to now, 83% of the species of the lives are got reduced. Lake Pupo of Bolivia has disappeared. The lake is no longer there. But these are the better known lakes. But look at Australia. How many lakes in the last few years? Around 30-40 lakes disappeared. So what? The question, yes. We have seen the lakes disappearing in Bangalore, in Chennai, not by a natural occurrence, but by man-made occurrences. There were more than 50 lakes in Bangalore. People from Karnataka know that in the city area. This once upon a time, but with the urbanization, with more construction activity coming up, there is no. These lakes have been filled. In Chennai, Red Hills, lakes have been filled. In Andhra, lakes have been filled and construction has happened. But where does the water go? Which are the places where the water used to be there? If the water is, if there is some place, there should be some place for the water to go. So the water floods into the city. Water finds its own place. It recovers the place. It recovers the land which was taken away from water. These are new kind of challenges. Then new types of risks are still there. If you are seen in the WhatsApp or WhatsApp groups, or if you are seen on Facebook or in many of the different areas, we have seen that new types of risks in the form of blackbirds coming into the city, which has happened in the USA, in multiple cities. Flocks and thousands of blackbirds coming in. There were white birds, cockatoos, which flew into the southern area of Australia. There are many migratory birds. They migrate after miles of flight. They reach a place, they don't find their water bodies, and they sit on every roof of every house. They sit on every car possible. People were now for days together, people could not come out of their houses in certain cities because there were birds everywhere, big white birds everywhere. People who go to the supermarket and buy and bring their grocery home, birds were plundering it all. The birds were taking away the grocery that we purchase. The birds are hungry. It is not. I'm not talking about hundreds of birds. I'm talking about thousands of birds. Please do verify about this on the internet. Thousands of cockatoos, how they created damages in Australia. Because the problem created by rats and mice in many of the cities, including New York, as well as in some cities in Australia, during the post-COVID scenario. How will the insurance companies handle it? We don't know. These are yet more challenges which are yet to come. We have seen cyber risks. And this kind of risks, which are coming out of rats and about vermin and about birds, they never anticipated them. There are a lot of concerns about estimating the probability. Insurance company works, friends, on two things: on frequency of an occurrence and the severity of an occurrence. Accordingly, they need to have the money. Please help them in measuring and estimating probable loss from past data and future projections. Concern of capital adequacy. How much of capital do they need to bring in for covering these losses? How to please help them in spreading losses over large numbers? The country is doing that already. If something goes wrong with the insurance company, if the losses are so huge that the insurance company cannot handle it, how will the government help it? Because it is ultimately the government's role, which has been taken over by an insurance company to some extent, philosophically. That is, if you look at it, I think Professor Santosh Kumar also would be talking about it in a country like USA or in Germany when there is a natural calamity happening. Around 10% of the losses are taken care of by humanitarian organizations. Around 30 to 40% losses are taken over by insurance companies, and the remaining 50% of losses are taken care of by the government. Whereas in countries like India, in the best scenario, only 8% of the losses have been taken care of by insurance companies because the insurance penetration is so low, and some 1 or 2% by humanitarian agencies, and the remaining 90% and more taken care of by the government. We are trying to reduce the liability of the governments towards taking care of its own people, and also to give the people the kind of best estimate of their risk, and accordingly so that they can do the best. Government gives incentives to taxes. There is a lot of coordination between insurers and reinsurers which is required. We need to work on win-win models for people beyond the mainstream. And we need to create awareness, understanding financial literacy. We cannot, NIDM and AAA cannot do this for the entire country. You are required to do that. We will help you. You have to help us. It has to be mutual. We need to work together. We need to provide the people access to insurance. There should be an insurance company so that they can connect it, or through the internet they should be able to connect. In many places, insurance connect is through the providers of loans, mortgages, and that kind of services, hypothecators and all that. But then it should be done directly through other better mechanisms. Insurances should be affordable. Subsidies only required to be given by government for a small period, for a short period, and after that, people have to buy services. I mean, the subsidies. I mean, they buy their insurances themselves. Insurance subsidies from the governments have to be only for a very, very limited time, because otherwise there is no point, because the government still pays for it. Till the people understand insurance and there is a willingness to pay, till the concept of buying comes to the insured in a 2-year, 3-year, 5-year window. During that period only there should be subsidies, and after that people should be able to manage for themselves. Government can give incentives. Government should be able to insist that insurance companies should be more customer friendly. There should be ease of doing business. Documentation should be better, and also there is the area of connecting through mutuals, cooperatives, and community-based organizations, self-help groups, and the like. We need that help from all the people who are here, and let us make India more risk-free. Let us make the country a better place to live in, especially for the people who are getting regularly or even once in a way affected by disasters. Thank you very much. Thank you for a patient hearing. I'm here in case you've got any questions to ask, and I hope I haven't transferred into Dr. Santosh Kumar's time. Thank you very much.
Thank you, sir, for this detailed presentation on insurance sector and its working and regulation. Also, the overview of insurance product like personal, physical, business, and liability. You covered the details of the various products of insurance, and we are grateful for this presentation. Disaster focus and disaster focus insurance you have included and also mentioned about this. Thank you so much, sir. Thank you so much. And now I would like to call Professor Santosh Kumar, Head GIDRR, Faculty and National Institute of Disaster Management. And he's a disaster risk reduction policy planning capacity development expert. He has more than 30 years of experience in different positions in the development planning and DRR sector, a PhD in economics. He studied gender and development in IDS Sussex, UK, and received a professional training in disaster risk management from Israel. Backed with international work exposure at the World Bank and Intergovernmental Body of SARC. Welcome, sir, for this webinar.
Thank you, Shipra, and a very good morning to Professor George and all the delegates from III, Mr. Deepak Godbole and other colleague. I don't know whether director has joined or not.
No, he couldn't.
Huh?
Couldn't join today.
Achha, he couldn't join today.
Yeah, he could not.
Okay, no issue. I today actually have come to IIT Delhi. There is a world conference which is going on, and just finishing that session, I am sitting in the IIT campus and in a very eco-friendly natural environment. So this gives me a kind of a pleasure talking from here, seeing the greenery and thinking about the risk, and also that in the sky I see every 5 minutes there is an aircraft from here to landing to the airport, which is going over the head of the campus. Very interesting deliberations made by Professor George on the this entire insurance, that how insurance could be useful, and how insurance could be taken to the logical end. What are the products which are available? Who are the ultimate insurer? What are the challenges of the products? What is the penetration level, and so on and so forth. Now, distinguished participants, I don't know how many states are represented there, but I'll see that how and why we are talking about insurance today in the sector of disaster management. Country has taken initiative for insurance, for crop insurance and also health insurance. We have motor vehicle insurance. We have the life insurance. So in the non-life that disaster management falls in. Now the question is that why we thought of insurance as an option for building financial resilience. In fact, if you all recently have seen that how COVID-19 is behaving, and what kind of a learning it has given. So day before the lockdown in the month of February 2020, and today is the month of December 2021, how the life has changed in almost 2 years of time. It's not the same as it was before, pre this pandemic and post-pandemic. But pandemic affected everyone. That is affected, meaning thereby if you are directly not getting the disease, but definitely you are getting affected by following protocols. Protocols are the appropriate COVID behavior. And that appropriate COVID behavior is trying to reduce your own risks. Why did you do that appropriate COVID behavior? Why did you do that lockdown? So, and you adhere to the law. The one is that government were declaring lockdown, and also enforcement agency was making sure that it is not violated. So these all were the risk reduction measures, reducing the risk and building resilience of the people. If you go out, you might land up in the kind of a trap of COVID-19. If you do not adhere to the COVID-19 appropriate behavior, you might have the chances of getting infected. And it's not that when you get affected, you live in the social kind of environment, family environment, and there you will affect further the potential that you can affect family members and also that community members. So that actually made everyone to understand that reduce the risk by zero, the zero tolerance towards the risk. So even if you're ordering any groceries from the market, we were going for hand sanitization, so going for the basket sanitizations. So all these were the exercise for the risk reduction. But you still remain with the residual risk. So like if we do the mitigation, we live in the house and we are living in the earthquake prone areas. And earthquake prone area is also like when we say that with in terms of we do not know as to how that earthquake would behave. And when we are not aware about how earthquake would behave, it is even much more challenging because uncertainties gets multiplied. So in similar situation, when things are uncertain, we need to ensure that uncertainties are taken care of. So similarly, when we see that larger disasters are likely to happen in the future, I will give you one example. Globally, when we are talking about is almost uh, $760 billion as an average annual loss, which might occur due to natural or hydrometeorological and other disasters. By 2050, if you add on, or by 2030, how much the $1 million it is going to be. So life is one, but the property is another. So here in the insurance, we are talking about non-life. And when the non-life we are talking about, non-life means always be a kind of a by any such tools which are good for reducing our loss, that should be thought of as an option. So that is the what we are thinking in terms of taking insurance. Second very important thing is this. One is this average annual loss, which I have shared with you. Second very important thing which would emerge as a kind of a large number of frequencies of disasters. So large number of frequency of disaster, meaning thereby is not necessarily is taken care of by the insurance companies. The higher the frequency, the insurance company might think that larger risks. So there then we have to think of whether the product which we are aiming for would be good enough to take care of the risk of the people. So when it comes to the frequency, intensity, and the impact, that one is this life threat. So how life threat is taken care of. The second very important thing comes is the property. And the large volumes of property are getting affected by disasters in India and also across the globe. So how the global communities are responding to such kind of a financial challenges. I was giving you the reference that what happened in 2 years of time in COVID. See and look at those families those who have lost their job opportunities. Those who were working and now given the pink slip and they are out of the job. Their liabilities, they have grown over the years. Their children, when they joined, were small or even not married, they were. But now they are married with the children, with the family, they are going to schools and everything. And suddenly it happens that the COVID-19 is not securing your position due to COVID-19. And the management has given a kind of a thank you notice and you are out of the job. What will happen? How we are ensuring our future? So this is one. The second is that disaster has taken away your all property in which you were living and surviving. You are taking shelter, say housing. So housing, how to protect? Like suppose you built that house at the 1990. At that time it costed must be, if you take a kind of average middle class housing in the big city and also in the middle class, in the medium type of, then there you find that it is affecting the lives of the people, and that if it is a quantifiable loss, then you can say that 25 to 30 lakhs on an average of the housing loss if any disaster strikes. So from where you will get the 30 lakh support or 40 lakhs or 50 lakhs, whatever you have invested in your infrastructure, whether movable or immovable property. So government, normally government has a disaster management funding system. So in this funding system, government comes with a relief money, which we call it as an ex gratia. The moment we say ex gratia, this is not a compensation. It's just a support to survive and to restart. So question doesn't arise whether it's a 5 rupees or 500 rupees. It is just for the survival, not for the entire recovery. We are saying that how family can recover from the shock. So looking at and where we found that the biggest, other than the health, the biggest thing is coming from the financial health. So when we talk about financial health, what is the strength which we have in the system, which can take care of that? So like in the agriculture insurance, people knew that in the agriculture that might get flooded, but might get drought for no rains. So if heavy rains, there is a loss. There is a no rains, there is also a loss. So people did not have mechanism to support themselves once the fasal income is gone. So they were also looking for that, and they started with the small microfinancing system or insurance system where they can have a kind of a clean area of operations and strategy for surviving. So there the financial resilience could play a very important role by bringing micro institutions, microfinancing as a kind of a building resilience. So what is happening in our case and generally when people are likely affected? So the moment disaster happens, government start with the relief, search and rescue, response and relief. And relief comes from the Calamity Contingency Fund. And now which is called by the 15th Finance Commission is the Disaster Response and Mitigation Fund, holistically. Earlier, there was no mitigation fund. So what is happening in the case when we talk about disaster risk management and building financial resilience, we are looking for an options. And that option, we might look for a kind of a bringing finance into operations. When this entire government funding procedure started, that time we had just a margin money schemes starting with the 500 crores. And today this has gone to 1 lakh crores of rupees. So you can very well imagine the starting with 500 crore as a contingent liability as a response. So how that has grown to 1 lakh crores per annum. So if we look at this means that look at the figure, then this means this is a kind of a financial impact which is happening on the day of the disasters on the people and the economy. So 1 lakh crore is just ex gratia. This is not for a kind of a money to be given for prevention and mitigation. So government did not have any choice but to look for an options. They can't start printing notes and giving to the people because it has its own international arrangement. If you are aware about that, how currency is prepared, what is the value of currency, and how it has been given promises. So we have a promissory notes. So in this, everyone is guaranteed amount of the value for which you have the note. So it now grown and people debated that 500 crore is not good enough. So the kind of casualty and the kind of support was required to be given to them. So 15th Finance Commission deliberated at length and came with the recommendation that yes, we need that, and all the players who are working elsewhere, they start looking at this as an option, financial option for building resilience. So ex gratia is one, building financial resilience is another. And in building financial resilience, there are many options left open for the people who are at risk. Say, for example, you already have insurance and you have interacted with the people. Then you have a kind of a other one, like which we say as a device, which is being used for assessment and also for the deliberations of the financial allocations. So now when we say that this disaster is happening and then operationalization of the disaster mitigation and response fund, which is now in the Finance Commission nomenclature, so that gets started. So then you might think that if that funny money is there, that what fun which we should have to having insurance. But this money is, suppose you are losing 50 lakhs, you will get only say ex gratia limited is if in case of death, the family will get 4 lakhs rupees, and other cases that would depending on the situation. So suppose we are not depending on the government, we are saying that the moment X, Y, Z, 3 factors are met, you will be entitled for the X amount of money or Y amount of money or Z amount of money. So that gave insurance in the minds of the people that yes, that we are there, and that if anything goes wrong, they will not only be given as ex gratia, but also they will be given compensation. But still today, there is no compensation involved in the post-disaster scenario. So best part is to work for the this new financial options such as insurance. So that led us to think that many of the states government who are highly exposed to various disasters, we looked at their fiscal health, and we found that large number of states are not having a kind of a very solid financial kind of a surplus to cater the need of the people.
Hello. We can't hear you suddenly. Santosh sir gone offline.
Typically, insurance, which is ex ante, and that the need is to look into for the perspective of disaster risk management and a kind of a and the qualified states that who would be going for insurance. So we had a tied up with the various insurance and reinsurance companies, seeing and realizing the international this experiences, that how they have been able to build this, and secondly also our own Indian experience of two of the scenario, that one is this health insurance, and also with looked into the agriculture insurance. So one pilot which is being done in the northeastern states. So the idea is to inform and educate people about the insurance and how that insurance could be utilized for building resilience towards resilience when it comes to the infrastructure, individual as well as the social infrastructure. So there we had this workshop, and we also looked at the different communities of the globe, like Turkey, we looked into Mexican, we looked into, and other places also. At even we looked into US and America and Africa. So every country's strength and weaknesses studied and how that tool was implemented. So when this NIDM conducted this workshop with the III, the strength of the insurance industries and the concern for the this building financial resilience, a complete initiative started in the country and leading to the working group. And that working group submitted its report to the Ministry of Home Affairs, which acknowledges the importance of insurance is bound to come as a kind of challenges which disasters are posing before the people. So when we look at holistically, what we say that if there is a 100 crores of kind of a money which might go waste when a disaster strikes. So what we are suggesting that for insurance, even if that if you have a kind of a building bylaws and code, look at the enforcement and in the whole of the scenario of building financial resilience. So that is much more important than just taking a program or taking actions on that. But idea is to actually have those kind of incentives where we can create a possible situation where we can say that X is benefiting and Y is not benefiting, or both should have been given the equal opportunity. So, friends, what I would say that it is very important to understand the importance. We say that if 100 million or 100 crores is going to be the loss, probable loss, and when we see that what are the agency, what is this thing, how it is getting hazed, then we see that ex gratia payment and this payment, that payment, all inclusive, we still find that uh, 50 to say 60% of the population are still to be trained in the country. So, friends, I would submit here, look at the 100 crores example in a way that if disaster happens, something you might get in the grant, something you might get as a kind of individual contributions to the state, something might be the deduction in the salary. But ultimately, which we need to look at, that how much is hazed and how much is not hazed. So for the residual risk, residual financial risk, how we are going to attempt. So for financial risk, it is important that we should have a kind of a alternatives, and those alternatives whether in the form of insurance or any other options. So we are trying with the state government, that state government should come forward and start looking at that. As we have been seeing that it has from margin money to it has gone to a different level today, and then we say that how that kind of a changes can also be brought in the financial planning for disaster risk management. So friends, I would just reiterate that this is very important tools, but this is not the only tools for building financial resilience. What we say, this is one of the tools, and where we can help the ministry department to come up with a kind of a product oriented framework where we can say that that this much of financial risk can be hazed and this much of financial risk cannot be hazed, and that is true for individual customer as well for the government infrastructure as well. So I would stop here, and if you have any questions, 10-15 minutes I would love to take.
Thank you so much, sir, for this deliberation. And now I would like to welcome all the state representatives to put forward their questions and if they have any queries. So I will, firstly, we would like to call Tamil Nadu. Is someone from Tamil Nadu there? They can ask any question. Tamil Nadu, if someone from Tamil Nadu is there.
Raise your hand and or unmute yourself and ask the question.
Andhra Pradesh.
Please go ahead, Andhra Pradesh.
Karnataka, if we have anyone from Karnataka.
Fair Shipra.
Tarun Kumar has raised their hand, and who? Yes, sir.
Just ask question from Andhra.
Yes, sir.
Professor George, do you have anything to add? The question is not coming. So can you guide them when we are implementing insurance at the state level? What are the stages to be followed? What are the preparation required?
That is something interesting. Yes, I would like to add there. That was where we wanted to go forward on this. The state government should have their own policy of what to insure and what not to insure. Some items it may be more feasible for them to insure because the state doesn't have to take the responsibility of their risk. So maybe some states do cover their all their vehicles. Some states don't. Some states cover some of their buildings, and some states cover none of their buildings. So there are places where the government has got financial stakes by way of hypothecation or by way of loans which governmental mechanisms have given. So those things, it is a matter of policy or how much you want to want to insure, go to transfer to the insurance mechanism, and how much you want to feasibly, within your own powers, within your own financial thing. It may be in some circumstances, it may be ideal to pass on maximum to the insurance companies, but in some questions, there will be some risks which don't happen at all. So there is a clear demarcation, a clear understanding of the risk which the governments need to take. First thing. And then the thing is that there's a governmental policy of how much to insure. Okay. There are other cases, there are houses which were rebuilt in the area of, say, in Gujarat after the earthquake. The government rebuilt the houses, and the government insured it for the first year. Second year, some people insured it, and from third year onwards, nobody insured it. Tamil Nadu government insured tsunami hit houses, whatever reconstructed for a 10-year policy. We don't know after 10 years how many of them have been renewed. The government cannot be insuring them forever. So, there is a lot of work which has been going on in Tamil Nadu with the help of IFAD, post-tsunami relief mechanism over there. They work pretty hard on this. They work for the fishermen. They work for fishing nets. They work for fishing boats. So you need to decide on what is best to be insured. This is one part. And secondly, wherever the government has got stakes in it. So that is the areas where the government need to tell people, okay, now we have bought you this for this long. For the future, you have to buy yourself. So this is another matter of a policy. If you leave it to the people, without anything, they may not insure it. But of course, this is possible that they'll come back and ask, okay, we need money to insure. The government can think of some subsidy, but that is a different thing. It's again a matter of policy. Then there will be, the state in Maharashtra, the state insurance fund is there. They're in Kerala as well. Kerala, Karnataka, Gujarat, Rajasthan, and Maharashtra. These are the 5 states which have got an active policy and an active state insurance department which insures part of the risk. Some have the capability to insure it themselves. Some work along with insurers and work on a co-insurance basis or some kind of a tie-up or a technical partnership. So there are multiple ways in which state governments do work. Question is now after we have seen these disasters in the last 5 years. Please go back. My request is to you to please go back and review what are the state's policies regarding insurance. Many of the states, we have got policies which were decided, formulated years back. So maybe today we need to look back and reassess, are we doing the right things? Is the state carrying more than what it can chew? So you look at the Kerala scenario. Okay, then another thing is that insisting that people, even if it is on their own money, government should tell them, okay, this is what is to be insured in your own favor. You're not doing a government a favor by insuring your stuff, but be protected yourself. You pay, if you got a costly building, and if it is in a belt where there can be affected by floods, you better insure it yourself, and the household also, and the household items also. So look at that. So the government can create an insurance awareness. The government can create seminars, webinars in schools, colleges, whereby the state is understanding what insurance is. Now there are more technical things about what kind of policies to be taken, how much of sum insured, there is technique which I'm not getting into as of now. But then working with the government should have more confidence in working with the insurance sector. That's what is a public sector insurance company or private sector insurance company, because you should be clear that it is all well regulated. And if there is a problem, you can definitely complain to the regulator. The government can complain, the individual can complain, mechanisms are well in place. And we are here to support you with any kind of knowledge requirement, whether there's a research to be done, whether there's a training to be done, NIDM is there, AAA is there. We even have local members. AAA has got around 3 lakh plus members across the country. They've got around 60 local institutions in different parts of the country. We can energize them. There can be a point from which you can source members. There can be a connecting point if you want seminars to be conducted in any colleges or any schools along with the state. We can also come down from Delhi or from Mumbai and support you in that. So please be insurance aware. Please be risk aware. Please be disaster aware. That is my plea to you. Please let us see whether there are any more questions are coming up.
Yes, sir. There is another question that for a multi-hazard state like Kerala, what would be the better option of disaster risk financing which can be implemented? So if a government plans to implement insurance, then what kind of insurance would be better, like direct, indirect policy or parametric insurance policy?
That is a very good question, very interesting question. The thing is that when you look at mode of insurance, it depends on whether it should be parametric or otherwise. That depends on the country's system, the state's system of assessing risk. Why do you go for parametric insurance? So basically, if you are having a car and it is insured, if the car is hit by another car or another vehicle, or car hits a lamppost, you want the assessment to be done perfectly, and whatever is lost by you to be paid to you. Okay? So if the insurance company says, okay, if there is a front hit, be paid 5,000 rupees. This is not what you want. If there is a side hit, you'll be paid this much of rupees. That is not, you don't want a slab. But then the parametric is creating that kind of slabs. So that is not the ideal way, because what a state government or an insurance company will not be able to go exactly to the spot and assess and find out exactly what is the loss. Here because we need surveyors, and surveyors may not be able to go exactly. Go for parametric. It's a parameter. Once the parameter is satisfied, if they say the district collector says that this particular district or these parts of these districts, these talukas have been hit by a flood or by drought or cyclone, then insurance is paid without getting into the actual assessment of the entire thing. That's not the ideal situation, but there's a practical situation. Practical solution which insurance companies and governments agree upon. Parametric. Based on this parameter, we will pay. So, it is something which the government has to decide on its own capabilities to assess the actual losses. If it is not able to, if the situations are not congenial for doing that, then we go for parametric. If you got a real situation where you can really assess how much of loss has happened to this building, then that will be the preferable thing. Actually, in this kind of things, people do first start with parametric, and then as the industry stabilizes, as the situation stabilizes, over a period of a year, they go to basic indemnity kind of products. And then to complete that kind of a question, the multi-casualty scenario, which comes in Kerala, there is no one-stop solution for that. As I was trying to tell earlier, it has to be multi-pronged policies have to be there. How do we take care of the buildings? How do we take care of the vehicles? How do we take care of the people who are involved? How do we take care of the governmental property? These are all to be dealt with separately. Nobody can design one package and we give it to you. Correct.
Comes to Mr. George, when it comes to the policy and building resilience, we have started with the housing. We are thinking that yes, housing could be taken as one of the components. And now multi-peril requirement is coming up in terms of one is this earthquake is one peril there, but the multiple damage which the state is asking this question that suppose X is given, Y is not given, and Y is given, Z is not given. So don't you think that this will also need to be worked out parallelly? Otherwise, it will create mistrust in the product itself.
Yes.
That product is not very much viable for those who are taking this as a kind of a insurance. We did discuss during the workshop also in the future, in the previous year, but it was all boils down to the housing to start with first, and then we will think that how that policy support can come from the government regarding the multiple damages, multi-items damage kind of a system. But the state government's readiness, that is, as you said, that AAL, average annual loss, has to be worked out by the state governments. And there we feel that state government requires some support from institution like us and institution like yours, and maybe the other agencies which are doing this kind of a work in the quantifying of the assessment. So if any state, like we are going to the other states, so how we should take up? Just I'm forwarding the question of the state which has come up in a little more, just adding, you can say that question to it. And I see Mr. Godbole is also here. Good afternoon, Mr. Godbole, and maybe jointly if we can think of that what kind of answers we may think at this point of time.
Surely, sir. It's our pleasure to do this joint exercise continuously for different states, because I believe that talking to different states on a continuous basis probably will help us to come out with what kind of a solution that is required. Certain states are such where this question was very interesting. Certain states are there where you can zero in on only 2 or 3 perils and say that this is the product that is to be offered, and then acceptability becomes easy. I would just like to give you an example because I come from the reinsurance industry, that India is like a subcontinent. Okay, so it's a big country, and what is unique to Kerala may not be unique to Orissa, may not be unique to Punjab. And this is what we experienced. I'm just sharing experience as to how difficult it is to handle this question of whether it would be one peril or multi-peril that is to be offered, because we experimented this with a cross-border and across the continents pool. It was called as a fair nat cat pool. So this pool is something which is going to cover a list of perils starting from China on the right hand side till going into Greece or Turkey or all these places. Now, what I'm trying to tell you is that the kind of variety of risk that would be there from China to Turkey is the same situation that we are in India. We have certain states which have major problem with the wind as a problematic thing. Certain areas on the north where earthquake is more important. What happens is, if we bundle up 7 or 8 perils and offer it as a package, then certain states will feel that I'm unnecessarily covering these perils and my premium is going to be more, whereas the similar things will happen to the others. So that's where I would say that you are absolutely right. We will have to work together. We will have to break our head to find out whether, if not all India, but if we can do this grouping. For example, today we are talking of the southern states, or we go to the northeastern states and all that. Definitely we can work out on a more packaged kind of system. That's what I thought I would offer from my experience.
But the more peril is added, the premium value will go high, and then concern for the, so that prioritized kind of a way we will be starting with the, and that is why that we think that housing is the most important one, and that was the idea. So yes, Professor George, you want to say something?
See, these things are, what Mr. Godbole was saying is on the dot, was on the dot, because the country has got so much of diversity. It is different kind of perils which are affecting the different parts of the country and that too affecting in a different way. But then having said that, 20 years back or 30 years back, if somebody would have offered a tsunami cover in this country, none of the states would have taken it because we were not aware of that kind of a risk to, I mean, that kind of a peril to come up. Say 20 years back, if somebody had come and said that there will be a flood cover for Chennai, people in Chennai, people would not have taken it because nobody could imagine that a city like Chennai, where the Britishers who created the city, who they never gave scope for a drainage. So that kind of a city would have a flooding situation. So now situations have changed. So that's why I was trying to say that no one solution would solve. And again, what Mr. Godpole said, the cost of it. It is something a rational thing to have. And to do this, we need to have data. That's why I was trying to emphasize on the requirement of data. If say Tamil Nadu has got sufficient data about what all kind of risks to cover, what are perils to cover on one side, what are the risks which could be most affected, and what the government can bear itself and what the government can't bear, then we can have a rationalized policy about what to insure. We see the amount at in Andhra, we see what happened 2 weeks back. The Tirupati hills, the Tirumala was flooded, and to what extent the upcoming roads were blocked, and the downgoing roads were the only thing, and people were stranded in between. Did we ever expect these things to happen? This is what we need to rework. The state governments need to work again and find out where are their exposures lying, what are the perils that they need to give emphasis on, and plan out. We can help you, as you said, as Mr. Godpole and Dr. Santosh Kumar said, we can help you out. We are not for-profit institutions, so let me just make that statement also clear. Neither the NIDM nor AAA are for-profit institutions. But because of our large tie-up and because of our existence in this country and because of our commitment to work for the government and for its people, so we are always there to help any state government, in planning this out. What there's a lot of planning involved, and we can't be doing the planning for you. We can empower you, we can teach you so that you do your planning yourself because you know where the shoe hurts. You are the wearer of the shoe. So without you, we cannot tell you, okay, you do this insurance, that insurance. No, that is not the way it is done. It is you. We are empowering you to do it, and you would do it. We will be in the background. We will support you, and insurance companies will also support you.
Sir, to the decision makers in the states, I have yet another suggestion. One is we have to come down from a very satellite that is on the up. So state is not the thing that will have again the same kind of risk coming down. We'll have to come down to local authorities. We'll have to come down to communities. So one good example that Dr. George was giving is that because maybe Tamil Nadu is today in the discussions, we had one very nice example of what is known as a post-tsunami PTSLP program that was running into certain coastal areas of Tamil Nadu. So that definitely works because then you know what are the perils and you know who are interested in covering themselves for that. So this, if we start coming from up to a bottom level and start taking a particular area where whatever problems that we have said that someone will be interested only in some perils, then they can be defined. Someone would not be happy to cover a peril which probably is not going to affect them. That problem goes away. And this also helps us, as Dr. George said, that some data has to be there. Now, this is one program. There must be multiple programs like this that we are probably not aware, where this particular scheme has run for 10 years. Now, there is a lot of learning to the government of Tamil Nadu, how this scheme was running, what was the pricing being made, how many claims came in, and who paid for that. Now, a single community thing may or may not work in 10 years and it will start looking not viable. But the whole principle of insurance is that learning from this community will start adding some more coastal areas into that and will make that as a product for a larger area. I just thought that this is another thing. I'm sorry, I'm actually giving two contradictory kind of views. One, I'm saying that we have an experience of a large scale thing and where we have failed to find out what this pool can do. But at the same time, I thought that this could be one solution, starting with small communities, coming to the local authorities, then coming to the states. We may one day find one solution where we have sufficient numbers and then the premium can be affordable for us.
Shipra.
Yes,
Sir,
sir.
one
We
Mr.
have few
Arkajyoti,
other questions.
yeah. One Mr. Arkajyoti Sen has asked a question. He wants to say something.
Hi, George sir. Hi, Deepak sir. So, I am a fellow member of Insurance of India. I am working for reinsurance industry. So, sir, actually, I am from West Bengal, but I am working in Mumbai. So, I have a suggestion that I am thinking in that way. Suppose we all, each and every state has the local authority like municipal corporation. Okay. So every municipal corporation has their own risk mapping. I mean, suppose if we consider as a catastrophic model, then we can say that the risk map, each and every municipality comes under, suppose flood exposure zone, suppose some kind of a earthquake exposed zone or something like that. So whenever the ordinary people, the family, each and every we used to pay the property tax to our municipal corporation or the local authorities. So when we pay that tax, can the municipal corporation also charge a insurance amount for earthquake, flood, and storm and insurance? So what happened? They know their risk mapping, their risk hazard. Is it a flood prone area or is it earthquake prone area? On the base of that, the reinsurer also help them. And in that way, if we design a product, if we get some product which helps the local authority to support them, and on the other side, suppose in case of motor insurance, we consider as a TP as a mandatory product. If we do some kind of thing which should mandatory for the local people in case of property. So what happened when suppose you are told just right now there's some kind of ex gratia payment. So that kind of payment when comes from the government, it also gives the government a relief when they are going to pay that amount. So we can also consider in that way also. I mean, this is a thought for me. I mean, I think I should put, and this is the right place to put on it. So that is why I'm putting it. So, George sir or Deepak sir, can you please suggest me whether is it feasible down the line or something like that? Is it possible?
Sir, it is absolutely fantastic that you have come up with this idea. This is something which New Orleans did 50 years back. And that was the beginning of ending their woes. It's a disaster-prone state, disaster-prone part of the USA. They were annually getting problems. I mean, Dr. Santosh Kumar can talk, lots about the US floods and cyclones and situations like that. But then the city commissioner came forward and he did precisely what you're telling, Mr. Sen, and created the hazard maps, what kind of perils can hit whom, where, everything they created, because no insurance company was willing to touch any particular risk there. So what they did is that they created a mutual kind of thing. All the people together of the city, they came together and they formed a pool and started insuring themselves. When they started insuring themselves, then the insurers got interested. Then the insurers came. In the 3 years they ran the pool, and the insurers came and they started doing it at a lower rate than what the city could do. So this is something typical. Fantastic. I know, like many of the state governments can follow this model. You can read about it as well. Thanks a lot, Mr. Sen, for bringing in that. Unless Mr. Godbole would like to add, or Santosh Kumar would like to add.
Thank you, sir.
No, we are fine with this idea because
I can hear you, Mr. Santosh Kumar.
are you able to?
Yeah.
So what I'm saying is that possibilities are always there, and when we are visiting to the states, and many of the state governments are here, kind of information from the support from the state when we're visiting and going to the municipal corporation, meeting with the municipal commissioners and the authorities, and see that how they see the merits at taking up the scale. But the only issue would come at the municipal corporation level, that scale would be little smaller. So premier value might go bigger. So, but we can think of across the different state, say so many municipal corporations. So probably that could be a better one.
Typical, sir. That is fine, because at the small level, it may not be able to sustain. It may not be sustainable, because if the entire municipal corporation gets affected, then we are in bad position. So that's why we start with states. We start the learning part, the background, the homework part is states. But when it comes to insurance, we come into clusters which are, which are sort of sustainable clusters. That's what Santosh said. So we have to and then we have to group things together and then create clusters. This is the way. Fantastic. You're not connected, sir. Can't hear you, sir.
Do you have any other question?
States of
Shipra?
Kerala, Pondicherry, Telangana.
Sir, your voice is breaking. The network connection is not proper, sir.
Can you hear me?
George, sir, your network is not fine.
Okay.
Now
Is it better now?
now it is fine. Yes.
Okay,
Yes.
it gives, yeah. The thing, what I was trying to ask is that do people from Kerala, Telangana, in Tamil Nadu, any of these states, do you have any questions to ask or any suggestions to make? Share any thoughts of yours? Please do that, because you're helping all of us by doing that.
Someone has asked that does the government in advance have bought insurance policies for damages that might occur to roads and public places? So this is the question.
No, I don't think. George, do you have any experience?
See, there are policies covering civil engineering completed risks, CECR policies, which have been introduced in the market something like 30 years back. That time, for culverts, bridges, and for the flyovers, people were taking it. But then later on, the interest went down. Now, the kind of policies for flyovers are taken by the contractors under the project insurances. But the government also used to take this civil engineering. There is a provision for doing it. There is policies available approved by IRDA, but then the interest has been lacking. But then, we have been a lucky country for a long, long period, and we never thought that this kind of things would happen. So now things are bad things are happening. We need to be looking at it more closely.
I can see a last question for today that some of the developed countries are providing insurance to its citizens for free of cost. Any steps towards this is being done in India? Can the institute make representation to Government of India to look into this?
Oh, see, this is something which is not the solution. It is telling that the government takes care of all the money. If the government is to pay all the money, the government can come and pay. But if the government pays, that is where I started my conversation with. It can pay only on a solidarity basis. Government cannot do valuation of each person's risk, and accordingly, government can if all the people who are in a capsized boat and who die, government can pay the same amount, but government cannot find out risk commensurate the claims. Government cannot pay accordingly. That's first thing. And again, government has got so many other things to do. Government has to run the entire country on on its health, on its education, its entire civic construction. Government has got lots of things to do. So that is why the idea of transferring risk from the government to the insurance mechanism comes in. So there are countries where it is transferred to the capital markets also. There are bonds, earthquake bonds and all that. That is at a later stage. We are not developed to that extent. First step is transferring things to insurance so that people can do it. Initially, the government does. The government has already done. There is nothing more as of now which a government can absorb. Look at the PM schemes, the 4-5 PM schemes which are in place. What the government has done, but there is more to be done from our side as well.
And government is already insuring as in the form of ex gratia. The minimum amount is there already. So government wish to transfer this risk to the insurance kind of a system. So where you can get the compensation, just not confined to the ex gratia support. That was, you can say that payout is very minimum if the government is giving, we are giving tax and government is giving ex gratia. But we are looking for what Mr. Josh says, that I endorse full yeah. But we need to look out for the solutions which we have already in the market. Global level, people are trying different options. India can also try. And this is the time where India can go ahead with the kind of a planning of insurance.
Santosh Kumar, I'll just add a point to that, which is something closer to all of us. We do travel by trains, by reservation. Everybody who books a ticket on the IRCTC.
Now it is insured, not travel.
Yes, 2 years back, I'm talking of the premium part. 2 years back, I'm sorry, 3-4 years back when it was introduced, we used to be paying 1 rupee as premium for a 10 lakh insurance cover while you are part of the journey, where you are inside the train. Because the claims ratio was bad in the first few months, it was kept stable for around 2 years. After 2 years, the claims ratio came down. The number of claims paid came down. So the railways and the insurance companies, the 3 insurance companies involved, they reduced it from 1 rupee to 74 paisa. And now it is further, last 1 year, it has been further reduced to 49 paisa. It is typical experience. Nobody is trying to cheat a customer, or when the cost of everything is going up. In the last 5-year period, 4-year period, the cost of insurance for a train journey, which will cover up to 10 lakh rupees, has come down from 1 rupee to 50 paisa. The government works for the public good. The insurance companies also, they are not allowed by the government. Okay, this only 1 rupee is nothing. Nobody bothers about it. But they are brought by the government to collect only 50 paisa. We should be aware that we are staying in a well-governed country, and there are good mechanisms which are in place. I just thought I will give you this example so that people have confidence in the system.
Thank you, sir. So these were all the questions. So we can, if you allow, can we move ahead with the vote of thanks?
Go ahead, and I would thank Mr. Deepak Godbole and also Professor George and all the state representatives who have joined and asked the questions. Shipra, formal vote of thanks, please. Thank you,
So,
Mr. Godbole. Yeah.
Sir, I would call Ms. Susan Sukanya, YP NIDM, for delivering the vote of thanks.
Thank you, Chipra. Am I audible?
Yes.
I wish to present a formal vote of thanks for this webinar on disaster risk financing and insurance on behalf of NIDM. I like to take this opportunity to place in a record a hearty thanks to the patron of this webinar, Major General Manoj Kumar Bindal sir, Executive Director of NIDM, for his support and guidance. I would also like to thank the convener of this program, Professor Santosh Kumar sir, Head GIDRR, NIDM, for his continuous motivation and support for this program, and also delivering the lecture and explaining in detail about this disaster risk financing and insurance. I wish to thank Mr. Deepak Godbole, Secretary General of Insurance Institute of India, for delivering the inaugural address. I wish to extend a sincere thanks to Josh E. Thomas, Professor from Insurance Institute of India, for taking the informative session on insurance sector, working and regulations, overview of insurance products and disaster risk financing. Once again, I thank all the respected resource persons of this webinar. I also wish to place a hearty thanks to all the participants connected with us from different parts of the country. I wish to thank all the representatives of state and central governments who managed to take out their precious time for this program. With these words, I would like to bring an end to the webinar on disaster risk financing and insurance. Thank you.
Thank you very much to all of you. Thank you.
Thank you.
Thank you,
Have a
sir.
good day.
Thank you, you too.
Thank you very much. Thank you, sir.
Thank you, sir. Thank you, sir.